Hello and welcome to the Australian Market Digest again for this week. Today's date is the 24th of June. My name is Stephen Hogan, your author of the Australian Market Digest, as well as regular guest expert on Sky Business Channel's Your Money, Your Call, Market Moves, as well as CNBC's Cash Flow from Australia. Now, just quickly before we start this week's digest, as always, let's just do some quick housekeeping. Please always remember that any information that goes out in the Australian Market Digest weekly video report is general advice, as it doesn't take into consideration your personal circumstances, objectives or needs. Before making any investment decision based on any information in this report, please make sure that you do consult your financial advisor or broker. I am an authorised representative of Novus Capital, and the opinions or views expressed in this report are my own personal opinions and do not represent the views of Novus Capital. If you are seeking any advice from a professional, please contact me at Novus Capital on 93750119 or visit my website www.stephenhogan.com.au, and on the website you can request some information there. Okay, so let's look at how the markets performed over the last week. Okay, so the Australian market made a gallant effort on Friday to sneak into the black, but pulled up short to make it two straight sessions of losses. We really have experienced some significant downside over the Australian market over the last couple of weeks. On Friday, the XJO closed down minus 19.6 points or 0.41%. To 4,738.8, whilst the All Ordinaries Index slipped by just 0.4%. A huge improvement from the close to 1.5% falls that started 30 minutes into the session on Friday. It really looked like it was going to be an absolute bloodbath on Friday after the price action in the US, but it actually ended up not too bad. And was a bit of a positive notion, to be honest with you, for the Australian market, especially considering the good volume that came through. The SPY did start at the market on Friday down 81, and it looked as though we were going to be heading there pretty early in the session, but the market rallied again and again to bring back the loss in check. The best performing sectors on Friday was energy, rising around about 1%, and the worst performer was the gold sector, falling around about 4%, which at one stage on Friday was down 6%. As gold was sold down heavily after Ben Bernanke's comments in relation to the US economy doing quite well, and the Fed's plan to pull back on providing stimulus and their bond buying program. Plenty of volume, as I said, changed hands on Friday with 2.7 billion shares traded worth 6.6 billion, indicating that the market's well supported down at these levels. For the month of June, the XJO so far is down 3.81%. Okay, so looking at overseas markets, US stocks did advance on Friday night our time, rebounding following the S&P index biggest drop since November 2011, after Ben Bernanke said the central bank may phase out stimulus by mid-next year, which I just touched on. The S&P rose 0.3% to 1592.4, after fluctuating between gains and losses during most of the session. The Dow gained 41 points or 0.3% to finish at 14,799. About 10.7 billion shares traded hands on US exchanges, the highest since October 2011, as futures and options contracts expired in a process which is known as quadruple witching, which generally leads to larger than normal volumes. Which happens four times a year. The benchmark index has declined. The S&P 500 has declined 4.6% since its May 21 high amid speculation the Fed will scale back quantitative easing. The S&P has rallied 149 days without a retreat, exceeding 5% or more. The last time we saw a drop of more than 5% was September last year through to mid-November, when the index dropped 7.7%. So we're looking at those sort of figures at the moment if the S&P keeps declining past that 5% level. For the week, the S&P 500 finished down 2.1%, and to date for the month it's down 2.3%. The theme continued in Europe as the benchmark FTSE 100 index posted its biggest weekly loss in 13 months. The FTSE 100 index fell 43.3 points or 0.7% on Friday to 6,116 at the close to finish 3.1% in the red for the week. So generally, when we look at global markets on a whole last week, obviously they did not perform well. Probably the best performing market, which we touched on last week in the Australian Market Digest, was the US market, which was the catalyst for the global sell-off. So they've actually held up pretty well. And in my opinion, US market at the moment is just sort of having a healthy correction here in the midst still of a very strong market. Okay, so let's now look at some analysis for the week and see what global indices is telling us, as well as a few stock-specific shares that I'd like to take a look at as well. Okay, so taking a look at the benchmark index for Australia, the ASX 200 or XJO. We've covered this a few times, but you can see here that we are bouncing off the 50 period moving average, looking at the weekly chart here at the moment. And we're still sitting above this second last swing high here, which I view as important, this level. We've broken one swing high, but you can't break two to remain in an uptrend here. So as long as we stay above this level, I would analyse the market as still being in a clear uptrend. When we've talked about the Fibonacci levels here that the market could possibly come down to, and if we just place the Fibonacci on the chart here at the moment, we can see here that in the report 2 weeks ago, I mentioned that I thought the market could come down to this 47.65 level, which was the 38.2, and I did say worst case scenario that we may come down to the 46.16 level, which is the 50% level, as you can see there. We're not far away from there, obviously, at the moment. The market did close at 47.38, so we're around about 120 points away from there. So it remains to be unseen, obviously, if we bounce from these levels. SPI futures are down slightly, around about 0.7% on Monday. So we could come down to this 50% level, which it looks like we are going to, and I would expect the market to find support there and to be able to hold these levels. You can see here the 61.8 level, the 44.67 is down below that last swing high. So if we can stay right at if we continue to pull back, we stay at this 50% level. That will also mean we'll stay above this last swing high that I've just got the cursor on over there as well. So some interesting times here on the Australian market. A very impulsive move downwards, which has come as a bit of a surprise, to be honest, how impulsive the move has been down, considering the US market has held up quite well. But we've also seen the Nikkei being absolutely smashed, and the Shanghai not trading very well either. So that's also contributed to the Australian market. Another thing that I just want to place some lines on the chart here. You can see there that bottom that we found in 2011, and then we had our first higher low, or I guess not first higher low, but major higher low before the significant rally. We draw a trend line across there, and we can see that we've got a few touches here on this one as well, which is just a parallel line, and that comes to right where the market is here at the moment as well. So from a technical perspective, certainly this level at the moment is very, very interesting. And with all the yield out there at the moment in the banks and so forth, you would expect now that the banks have come back, we've had some decent pullbacks here on the banks and some of the high yielding stocks, that the market should now be pretty well supported down here, which we saw late last week. So I'll just move them off the chart now, and I'll just move to the daily just quickly, just to have a look at volume, and you can see there volume did spike on Friday, as I mentioned, and we had a really nice bounce off that low. You can see here we made a nice tail there. We've got a nice tail here. They're generally good signs for a short-term low. It's commonly known, that candlestick pattern, as a hammer, and is a good short to medium term indicator that the market is finding a low at those levels, and you should get a short to medium term rally off there. Okay, so let's move on to overseas indices now, and I'll just bring up some of the US charts. So we'll take a look at the S&P 500. We'll just go out there, bring up the weekly chart. You can obviously see that we're still in a very clear uptrend here from that 2009 low, higher low, higher low, higher low. More of a consolidation here, and now we're just starting to see some weakness. So, haven't seen much of a pullback in the US. We're getting close to that 5% level from the high, but we're sort of in, as I mentioned 2 weeks ago, we're in a bit of no man's land here with the US indices. You can see there that off the 50 period moving average, the market has generally bounced. So it's suggesting to me that we may break this last swing high or consolidation and come somewhere down into here somewhere and see a little bit more weakness in the US. However, I still think that this overall move or overall uptrend is still in place, and what we might get now, in my opinion, over the next couple of months is some complacency in the US markets, where we just get a big sideways trading sort of action, and we may just trade in a range here of somewhere between here, this level, and the high there, and just trade into the last quarter of the year, just in a big trading range between these two levels, and until people are prepared to step in and buy the market and see how the Fed reacts to economic data coming out later on in the year. As there is talk, obviously, of the bond buying program being reduced. So as those economic figures are coming out in the US, and the Fed obviously makes announcements in relation to those, we'll get more of an idea. But from my analysis, I think the US will now just trade in a bit of a range here and be a bit directionless for the next couple of months. Similar thing on the Dow, obviously. Okay, so let's just have a look at European markets now. Just see if I can find that the FTSE chart. So you can see here on the FTSE, we're down at obvious support levels here at the moment. We had a bit of a break there late last week, so it'll be interesting to see how the market reacts to those. And as we zoom out from the long-term trend, you can see here if we place a line on the chart, it just suggests that we may see a little bit more weakness down into these levels. Previous resistance has been at these levels around about here, so we may just get a little bit of further weakness on the FTSE down to this 6,000 level, which would make sense if we're thinking the US markets just might come back a little bit deeper, as well as the Australian market down to that 50% level. And it's a similar sort of thing on the DAX as well. If I just take a look at the German market. We just zoom out. You can see a similar sort of theme happening there on European markets, where we may just come back a little bit further here to that trend line, bring the German market back down to around about that 7,800 level. But common theme on the European markets, that we may just come down a little bit further. Obviously, similar sort of thing on the US markets as well as the Australian market there as well. If we have a look at the Nikkei, zoom in a little bit further here. I just want to place a Fibonacci on this chart, just to sort of see where we are in the scope of things. And you can see there we're almost back to that 50% level correction, the 50% Fibonacci level. Broke through it, rallied, is testing the 38.2. So we may just come back down a little bit further into here as well on the Nikkei. And if we look at the, just lastly, I just want to take a quick look at the Shanghai Composite Index. And we'll zoom right out on this one, give us a clear picture. You can see there that we've come down quite far on the Shanghai, and they haven't had any real significant sort of rally like we've experienced on the Australian market or the US market, despite the fact that they're the main reason for global growth. Looks like it may just want to come down here and make some sort of double bottom. So once again, a common theme here at the moment, that it looks like just global indices just want to come down a little bit further. But I do think overall, when I take a look at all the global indices, that we are certainly down near a low, and that this correction that we're in the midst of at the moment is almost complete. And then we just may get some sort of consolidation whilst investors and fund managers and so forth digest that information before we get any sort of significant rally. On the Australian market, I'd suggest that we may trade in some sort of range until the election has completed, and then as those interest rates flow through into our economy, we start to see some strengthening data, as well as the Aussie dollars had a fairly decent correction now, and that flows through into the economy. Potentially we start to see some upgrades come through from some companies going into the end of the year, early next year. I'd expect some good results by the Australian market late this year, and then I think 2014 should be a cracker of a year. But all indications are at the moment we may just go a little bit lower and then trade in some sort of consolidation. That's my thoughts over the next couple of months. Okay. Now let's look at some stock-specific analysis. So one stock that we recently bought for the model portfolio was 7 Group, SVW, not to be confused with 7 West Media. 7 Group does hold interest in 7 West Media, but it's an asset obviously in itself. You can see here, very interesting technical chart here on 7 Group, SVW. We've had a double bottom around about this $5 level back in late 2008, mid 2009. We then had our first higher low, another higher low. That higher low level supported another rally, and we're back down at these levels at the moment. You can see when we get down around about these levels, we have some significant rallies here. Like we had a close to 100% rally there, and another rally there of around about 30%. And more recently, this rally of close to around about 90% or a little bit closer to 100% here again off this level. It's a very well supported level, and we're down around about there at the moment, as you can see from the chart. So really good risk-reward trade here on 7 Group. You can be reasonably confident that we will get a bounce off this level, whether it's another significant rally of 100%. Remains to be unseen. I think we can definitely get something, minimum case scenario, we can get something like this, like a 30% move from this level up back towards $8.50. And you can place your stop just here, just below this $6.50 level, as if it continues to decline and breaks this level of support. Then it's really hard to guess or to estimate where the stock could end up if it breaks that level. But really good risk reward trade here. We've got significant potential upside, and our level of risk is quite low, with our stop just being just below this level here. I guess the main risk with Seven Group is obviously it's an investment style business. It has investments in Caterpillar that provides mining services equipment, those big cat machines. So our risk is that side of the business. In that the big miners continue to spend less and reduce capex, and the Caterpillar business being affected by that. At this stage, it doesn't look like it's had too much of an effect on the business going over its last report and its expectations. So I'm confident in buying the stock here, as well as their investment in Seven West Media as well. Whilst that media sector has struggled, Seven West Media has had a pretty decent rally, and as the interest rates flow through into the economy, we'll start to see that media space pick up as business confidence improves, maybe with a change of government as well, and we'll start to see a bit more advertising in that space. If you look at all the free-to-air channels, Seven has the best programming by far, unless you're a massive sports fan. When it comes to normal programming, Seven has the best programming in that space. So they will, as the economy improves and as the interest rates flow through to business, and advertising revenue picks up, in my opinion, Seven West Media will be a great benefit of that. But however, I like the diversification of SVW, Seven Group Holdings, as well as I obviously like this technical chart here. So going to buy SVW with exposure to some diversified exposure to the cat business as well as Seven West Media. The next chart I want to take a look at is another stock that we did buy in the model portfolio, and that's TOL Holdings. You could say this is more of a fundamental based trade. However, technicals are also looking quite positive here as well. You can see here we had a major low, higher low, nice bounce, and then obviously that pullback there was quite drastic. And then we had a rally off that low, more of a consolidation than a pullback here, and then it continued to go on with it. So we're looking at a 5-wave pattern here. So first wave up, second wave, which is a long drawn out sort of consolidation, messy, which is normal characteristics of a wave 2, and then wave 3, very strong rally, bigger than wave 1, which it obviously is here. Generally, a wave 4 will be a little less impulsive than this, and there won't be any overlapping. There's only slight overlapping here, and then the rally. It staged a rally here off that low, and we can see down here the volume's actually been quite good in that last week. TOL gives you good exposure to once again interest rates flowing through into the Australian economy, and if we just take a look at the fundamentals of the stock. We can see here that earnings per share growth is meant to be, forecasted to be 5.29% for 2013, and then a jump of around about 2.5% to 7.87% forecasted for 2014. It's on a yield here, as you can see by the cursor, around about 5%, fully franked. Trading on a PE of around about 13.4, and with those forecasted earnings, that should come down to around about 12.2. We can see consensus target on the market here is quite conservative, around about $5.46. I'd probably be a little bit more bullish on that going into 2015. I view this as a good long-term investment to get exposure to the Australian economy. But nothing really wrong with those fundamentals, what we're seeing there. Just go back to the chart. So I'd expect a rally up to somewhere between $6.50 and $7 within the next 12 to 18 months. The last chart I just want to look at here is AGK, AGL Limited. You can see here if we just draw an obvious trend line from the bottom of the candles. You can see there that we're right at that trend line there at the moment. Right at that, should find support here. AGK is obviously a fairly stable sort of business, being a utility. So if we just duck over to the fundamentals here quickly and take a look at those, just to make sure that they're satisfactory. Earnings per share growth forecasted to be 9.9%, which is reasonable. Profitability ratios are quite low. Return on assets, return on equity, but that's normal for a utilities business. And then 8.46% forecasted earnings for 2014. 100% fully franked yield dividend there, and it's yielding around about 4.4% at the moment. Consensus target amongst brokers in the market is around about $16.53, and on a PE of around about 11.92 currently, forecasted earnings will take it to around about 11.79. So nothing wrong with that. Generally, in that utility space, the PE ratios will be trading a lot higher than that, and you can see here. It's industry peers around about 23.64 at the moment, trading on PEs around about 23.64. So I believe the stock to be quite cheap here at the moment. Should find support here. If we get a major breakdown here, it's another good risk-reward trade. Whereas if we do get a major break, you can probably just look at getting out of it. But I wouldn't see if I can just put a major line here. I'll just move that. I wouldn't expect the stock to break this level. If we do get a major break of this trend line, your probably worst case scenario is downsides around about $13.06, where you can see bounced off that level. Sort of bounced off this level here, but we did get a major breakdown before it impulsively moved back up again. Support level, support level, support level, support level, support level. So this level, this $13 level, is really quite substantial for this stock. So around about $1 downside, and your upside is back up to around about this $16.50 level, just trading in big ranges, this stock. So it can be one that you can maybe not use as a long-term investment, but just use this as a trading stock over the next 12 to 24 months, and just trade these nice big ranges that it seems to be putting in place. So, just in summary for this week, sorry, just losing my voice here. We expect some we'd expect some more downside in global indices, as well as the Australian market may just come back down a little bit further before a consolidation here over the next couple of months, and for the markets to be quite directionless here for a little while, and then some strong buying come back into markets, global markets, end of this year, and then throughout 2014. I think 2014 will be a stellar year, especially on the Australian market. And then just looking at stock-specific stocks, we've got SVW, which we believe is a good low-risk buy here at the moment. TOL Holdings, a long-term hold here. on exposure to the Australian economy and those interest rates to flow through, as well as the low Australian dollar, and then also AGK here as well. More of a short to medium term play, just looking to trade these ranges that are in place at the moment. Okay, so that's it for this week. Please feel free, if you're not a client already, please feel free to visit the website www.stephenhogan.com.au. Here's the website here. As usual, you can, if you're not a client already and you'd like to have someone go over your portfolio just to see if your strategy is current with the existing market, if you're paying too many fees, as well as we can discuss with you the benefits that we can provide you, such as writing covered calls and generating income into your portfolio. Then please fill out the free portfolio review, which you can click on there, or you can go to the free portfolio review page. We also have the blog there as well for anyone who wants to request a certain stock 1 week for us to take a look at. The press room, which is obviously all our recent appearances on CNBC. We do have some on there as Sky Business as well. And yeah, that's it for this week. Thanks everyone for tuning in. And I look forward to bringing the Australian Market Digest to you again next week.